high W-2 earner and stay-at-home spouse power couple move with real estate. This is a great strategy for couples where one spouse has a high income from a W-2 and the other spouse has the time and interest to manage real estate activity while at the same time staying home and not having a W-2 themselves, whether they're spending time with the kids or doing charity work or that sort of thing. This arrangement leverages the IRS tax code to create significant tax savings while building long term wealth. High income tax professionals, such as physicians, attorneys, and executives, who often find themselves in higher tax brackets, stand to gain the most from this strategy. Essentially, what we're doing is qualifying the stay at home spouse as a real estate professional under IRS Rules Section 469. Real estate professionals can't reclassify rental income losses from passive to non passive, and non passive losses are only deductible against non passive income, including W 2 income. But if you qualify as a real estate professional, we can now take these losses that were previously passive and offset active income, including the W 2 income, and create massive tax savings. To qualify as a real estate professional, the spouse must spend 750 hours annually participating in real estate activities, and more than 50% of the spouse's working time must be in a dedicated area of real estate called a real property trader business. Material participation is another requirement as well, which can be achieved in several ways, such as managing properties, meeting with tenants, and overseeing repairs. There's more to it, but the gist is you got to spend at least 500 hours in the rental activity or 100 hours more than anyone else. And then the status allows you to take rental property losses, including depreciation, and fully use that against the W-2 income. Then we can pair this with a cost segregation where we accelerate depreciation into year one, and that allows us even more depreciation to massively offset a W-2 earner's income. Let's go into the technical breakdown. Depreciation is a key tax tool in this strategy. When you purchase a rental property, its value, excluding the land, is depreciated over 27 and a half years for residential properties and 39 years for commercial properties. A cost segregation study accelerates this depreciation by identifying components like appliances, HVAC systems, and landscaping, which can be depreciated over 5, 7, or 15 years. And then with bonus depreciation, introduced under the Tax Cuts and Jobs Act, taxpayers can deduct up to 100% of qualifying assets in the first year, which is phasing out after 2023. This can substantially create paper losses that offset taxable income. Currently in 2025, we're looking at 40%, but we are seeing tax laws that could come up, bringing it back to 100 for later years. Now let's move into an example. John, earning $800,000 annually as a corporate executive, places him in the highest tax bracket, and his wife, Sarah, manages their real estate investments full-time. In 2024, they've purchased a property for $750,000 and used it as a rental. A cost segregation identifies $200,000 in components eligible for year one bonus depreciation. John's taxable income is then reduced by $200,000, and assuming a 40% combined federal and state tax liability, this saves them over $80,000 in taxes. Meanwhile, the rental property generates cash flow and appreciation over time. This strategy not only cuts taxes, but also allows them to build longer term wealth faster by converting tax dollars into equity in real estate assets.